All right, higher for longer. The fact that benchmark interest rates may not come down so fast means mortgages, loans, any borrowed cash is going to cost more. But it's not all bad news here. There are some stocks that you might want to take advantage of while they're still cheap. For more on this, we've got Keith Buchanan, who is the GLOBALT Investments Senior Portfolio Manager, here with us. Keith, great to see you. First and foremost, when we look at the market over the course of this week and some of the volatility that we've seen, perhaps there are some buying opportunities where investors are beginning to nibble on. What are you tracking?
Thank you so much for having me. We've looked really all year long at just how much the market has moved from having 6 rate cuts this year. It's almost 7 at the beginning of the year to now to 4 to now 3, maybe even 2. This last mile of inflation will be stickier, will be more difficult, and higher for longer has become, back into the lexicon of how market participants are thinking about the rest of this year. We're looking at lower duration assets. We're pulling away from higher duration assets. Higher duration assets have a lot more volatility when interest rates move dramatically, particularly on the longer end. So we're looking at value assets as well, ones that pay a yield that's higher, whether it's on the fixed income side or on the equity side. And those tend to be stickier, lower duration assets that perform well in these environments where the assumption is inflation and interest rate could be higher for longer.
For those out there that may be wondering, what are the characteristics of value stocks? What are the parameters that they should be looking for, or the checkpoints?
Absolutely. Value stocks are instruments that have a lot more cash flow or earnings per the dollar you have to pay for the stock on a price to earnings basis or price to cash flow basis or an enterprise value or EBITDA basis. There's more bang for your buck as far as what the company earns per what you have to pay for that particular equity. So that is traditionally been your industrial stocks. It's been energy stocks, some consumer stocks as well. These have not been in favor over the last several years. It's been all about AI all the time and technology and those kind of ancillary stories, if you will. And some of those equities that come from very profitable companies have just lagged because they haven't been in favor. We're picking around those names and those stories that offer that lower duration, very durable cash flow, very durable earnings flows that offer our portfolios a lot more diversity, which we think will pay off in the coming year.
Keith, this is the second time in 2 days that we've been talking about portfolio diversification. What does a healthy kind of proportioning or portioning of that portfolio diversification look like from your purview if people are looking at the percentages that they're weighted in one direction or another as it comes to their investments? It's more for us. It's more of a sense of owning things that isn't typically in favor at all times. That's kind of uncomfortable, but that's a mantra that, from an investment perspective, we feel like it's necessary, particularly in times of dramatic, paradigm shifts like we're in right now. Owning energy over the past 4 or 5 years hasn't been the sexiest place to be. Owning Walmart, names like Waste Management, haven't been, necessarily the places that everyone's talking about as far as owning equity portfolios. But we want to make sure that we're shifting away from and selling into strength of some of the AI larger tech names that have done extraordinarily well and frankly have encompassed a larger part of our main indices as we move around markets. We want to shift away from those names as they continue to win, sell winners and rotate into names that haven't done so well. And doing it on a continuous basis over the past 3 or 4 years hasn't been the way to win. We think the paradigm shift is coming now. Will prove that that age-old mantra of buy low and sell high to prove right over the coming years. Keith, thanks so much for taking the time here with us today. Keith Buchanan, who is the GLOBALT Investments Senior Portfolio Manager. Appreciate the time.
Thank you.